Today's program is the taxation of forestry income and payments. I'm Dr. Tamara Cushing at Clemson University. This timber tax educational opportunity is provided to you by the Forest Landowners Tax Council through a grant from the Forest Landowners Foundation. The Forest Landowners Tax Council is a national nonprofit organization dedicated to education of and providing a voice for family forest owners on issues of federal taxation. Our agenda for today's program includes discussing the two types of income, looking at the taxation of gain, and then discussing the taxation of cost share payments. We'll start today by talking about ordinary income. Ordinary income, in its most obvious form to most of us, is in our wages. Our ordinary income as individuals is taxed at marginal rates of 10 to 35% for individuals. Marginal rates simply refers to the fact that each dollar you earn is taxed at a different rate as it goes through the income tax system. Your top rate, whatever it is the rate that you're going to pay on those last dollars that are included in your income. For 2013, that tax year, we added a new top tax rate of 39.6%. This rate affects individuals who make over $400,000 and married filing joint that make over $450,000. Now we'll look at capital gains income. If you have a long-term capital gain, you see lower tax rates. For 2011 and 2012, those rates were 0 and 15%. These rates correspond to ordinary income tax brackets. In 2013, a new long-term capital gains tax rate was added. We now have a 20% bracket that will correspond to the same individuals that are in the 39.6% tax bracket. Those who report over $400,000 for individuals and $450,000 for filing joint. In addition to these lower rates for those with long-term capital gains income, you also pay no self-employment tax. This additional tax is 15.3% in addition to the other taxes you've already paid. In addition to those two benefits of having long-term capital gains, you can also use capital losses to completely offset capital gains. Your capital losses may only be used to offset up to $3,000 if it's considered ordinary income. We hear a lot about corporations and people believing that they get different treatment than they should. Know that corporations qualify for capital gains treatment, but they receive no rate change. They pay the same rates on capital gains as they pay on ordinary income. So let's look at how you qualify for capital gains treatment. In order to have those long-term capital gains benefits, you have to have held the timber for a certain period of time. The timber or the land has to have been held for more than 1 year. If you've received the property as a gift, you count the time that the donor had it as well as the donee. Those two time periods added together, as long as they exceed 1 year, then it'll qualify for long-term capital gains treatment. If you've inherited the property, it's assumed that you've met the holding period test of 1 year and that the property will qualify for capital gains treatment. So let's look at an example timber sale to see how these gains work. If we have a landowner who sells timber on 50 acres and they receive $65,000 for the sale, they have sale expenses of $5,000 and are in the ordinary income bracket of 35%. Being in this ordinary income bracket of 35% puts them in a capital gains bracket of 15%. Let's look at what the after-tax receipts are and the tax bill that these landowners would receive. It's really critical when you're doing a calculation such as this to remember the basis. I have a separate video that discusses basis. I refer you to go look at that to try to understand how that is going to interact with this sale process. So the landowner has $15,000 in the basis account that's available to be used for this transaction. The formula we're going to follow is to take the sale proceeds, subtract the expenses, subtract basis, and we'll have our taxable gain. So for this example, we had $65,000 worth of sale proceeds. We had $5,000 worth of expenses and $15,000 in the basis account. Running that calculation, we determined that we have $45,000 worth of taxable gain on this transaction. If we take that $45,000 gain and the landowner's in the 15% capital gains bracket, we can take that 15% times $45,000 and know that the landowner owes $6,750 in taxes on this particular transaction. If the landowner had not qualified for long-term capital gains treatment or had actually failed to quantify it as such on the tax return and reported it as ordinary income, they would pay $15,750 on the same transaction. Now let's look at a little bit different situation. Previously we were talking about someone who sells the timber standing on the stump. In this situation we have a landowner who has the timber cut and then sells the logs. So this is a sale of cut timber. You're no longer selling a capital asset. When the tree's standing, it's considered the capital asset. When it's on the ground, it's no longer the capital asset. So unless something is done otherwise, the Internal Revenue Code tells us that this is ordinary income. However, we have the ability to make an election called a Section 631A election that will allow us to report the sale of cut timber as a capital gains transaction with an ordinary income component. So let's look at this Section 631A election. It's going to break the sale proceeds into two sections: the gain from holding the standing timber, and then the value added by the conversion of the product into other products. So the capital gain component, the long-term capital gain component, it's a deemed sale of standing timber to the owner. And that's going to be deemed to happen on January 1 of the tax year in which the timber is to be cut. So in order to calculate the capital gain, we're going to look at the fair market value on January 1 of that tax year and subtract out the adjusted basis. That's going to tell us the amount of the capital gain. Now, in order to determine if it is indeed a capital gain, because we're looking for that holding period, it's how long did you hold the timber, but it's when it's actually cut. So we're not looking for you to have it a year as of January 1, but rather a year at the time that the timber is actually severed. You have to do this election in writing. The ordinary income component, we're going to look at the cut timber as having a basis of whatever that fair market value was on January 1. Now remember, for the capital gains component of it, we looked at the value, the fair market value on January 1, and that's the sale. And so now, as the new owner of the product laying on the ground, that's going to be our basis, is the fair market value, what we bought it at. So to calculate the ordinary gain, we're going to take the sales price, subtract that fair market value on January 1, also known as our basis, and then subtract out our expenses. And this will give us our ordinary gain income component. So let's put some numbers to this and see what it actually looks like. We have a landowner who cut 60,000 board feet in 2013 from a tract that they purchased in 2011. So we know that we've met the holding period requirements because we've had the tract since 2011. The logs are then sold later in 2013 for $9,600. We'll go back and look at the fair market value on January 1, and that was determined to be $7,500. So let's look at the gain from the sale of the standing timber. Now remember, this is a gain from the sale of selling the timber to yourself. So we looked at the fair market value on January 1. It was $7,500. We had a basis already in the account for that timber that was cut was $1,460. Subtracting those two gives us a gain on the sale of $6,040. That's the capital gain component, and we'll receive the long-term capital gains rates for this transaction. Now we're going to move into looking at the gain on the sale of the cut logs. This is the ordinary income component. So we have the sale proceeds, what somebody actually bought the product from us for, $9,600. I'm going to take out my basis, which is also that fair market value on January 1, which was $7,500. Subtract my sale expenses of $1,500. And that's going to give me a gain of $600 on the transaction. So I have an ordinary income gain of $600. And that's going to be taxed at my ordinary income rates and subject to self-employment taxes. Now, an important side note, on effective January 1st of 2013, we had a new net investment income tax. That tax is 3.8% for those with an adjusted gross income over $200,000 for individuals and $250,000 for those who file jointly. This new tax is on capital gains income that's considered passive in nature. This is an important tax to pay attention to for forest landowners. Forest landowners need to determine if they are actively or passively involved in their timber holdings. The best way to do this is to talk to their accountant and their financial planner and determine if the activity level that they have will allow them to be considered actively involved in the timberland. So it's just something to watch out for. Again, I highly recommend you talk to an accountant about it. So we've talked about the sale of standing timber and the products on the ground, and now we need to talk about some of the other things that we receive, cost share payments. So by definition, income is taxable unless it's specifically included somewhere in the Internal Revenue Code. However, there's a code section that allows us to exclude part or all of the payment received for cost share purposes. The code section states that it has to be a payment determined by the Secretary of Agriculture for conservation purposes. However, you may elect to include this taxable income in your taxable income if you feel like it's going to benefit you in other parts of your income tax return and how you're meeting other thresholds. So the payment has to be a reimbursement for a capital expenditure, which means if you can deduct the operation that you did, so if you had an expenditure for something that you could deduct, then you cannot exclude the payment because they want you to include the payment in your taxable income and then deduct the actual expenditure that you had. If you're taking reforestation expenses, you cannot deduct the reforestation expense and exclude the cost share on those same expenses. So how do you figure out how much to exclude? You're looking for the greater of these two things, either $2.50 per acre divided by the interest rate from the Farm Credit Bank, or 10% of your average annual income over 3 years, also divided by the interest rate from the Farm Credit Bank. The greater of these two is the amount that you're going to be able to exclude. Thank you so much today for your participation in this educational opportunity. I'd like to thank the Forest Landowners Tax Council for the funding required to put this together. I'd encourage you to visit www.fltc.org and join the Forest Landowners Tax Council. They are, after all, trying to educate forest landowners on federal taxation and to advocate for tax policies that work for our forest landowners. I'd encourage you to like the Forest Landowners Tax Council on Facebook and then to visit FLTC on Twitter at FLTC96. On behalf of the Forest Landowners Tax Council and Clemson University, thank you.